There are literally hundreds of different financial ratios used in practice. Fortunately, you don't need to know them all. For purposes of the exam, you do need to know all the ratios in this presentation. That is, know the ratio given the name, know the name given the ratio, and be able to calculate the ratio given financial statements. We put the ratios into 4 major categories depending on the issue the ratio is designed to address. How much debt does the company have? Leverage ratios. What the position of the company is in terms of short-term cash flows, liquidity ratios. How efficiently the company manages its assets, efficiency ratios. And how profitable the company is, profitability ratios. Sometimes there are slightly different ways to calculate the same ratio. You only need to know the definitions presented here, but be aware that you might see different versions in other classes or when you are out in the business world. It's important to remember that financial ratios are designed to help you understand how well a company is operating. And so for each ratio, you want to focus on what the ratio is trying to measure in terms of business activity. Liquidity ratios measure the ability of a company to pay short-term debts using short-term assets. The simplest ratio divides the current assets by the current liabilities. A larger number is better, and a number greater than 1 indicates that the company's current assets exceed its current liabilities. A problem with this measure is that current assets includes inventories and receivables, which may be overvalued in the financial statements, since there is no guarantee that inventory will be sold at the expected price, or that receivables will actually be collected. An alternate ratio is the quick ratio, or sometimes called the asset test ratio, which removes inventories from current assets. Even more conservative is the cash ratio, which removes both inventories and receivables, leaving just cash and cash-like items. Since a firm will likely sell some of its inventory and collect some of the receivables, the cash ratio is probably too conservative, while the current ratio is too optimistic. If short-term cash flows are an issue, it would be better to go beyond the liquidity ratios and look directly at the cash budget and the assumptions that are built in there. Efficiency ratios look at how efficiently a company uses its assets. Since assets are costly, the fewer assets a company can use, the better, as long as it doesn't affect its ability to sell its product. Here are 2 commonly used efficiency ratios. The asset turnover ratio is calculated as revenue over assets and looks at the efficiency of using assets in general, although sometimes it's restricted to long-term assets. The more revenue a company can generate for a given level of assets, the more efficiently it's using its assets. Of course, different industries require different amounts of assets, and so you want to compare companies in the same industry. The inventory turnover ratio looks at how efficiently a company uses its inventory. It typically uses cost of goods sold instead of revenue to separate the effect of inventory cost from profit margin, the difference between the sales value of the product and what it costs to produce, since the cost of inventory is closely tied to the cost of goods. Revenue and cost of goods sold numbers come from the income statement and so are values over a year. Assets and inventory numbers are from the balance sheet and so are for a point in time. To make the numbers comparable, the value of assets and inventory are typically calculated as the average over the year, which you can estimate as the average of the assets at the end of the previous year and the assets at the end of the current year. There are 2 basic ways that we can use financial ratios to investigate a company's use of debt. The first approach compares the amount of equity with the amount of debt, which can be done in several ways. The debt-to-asset ratio shows the percentage of assets financed through debt. The equity multiplier shows how much equity is used to support the amount of assets. The more debt a company uses, the more assets it can support with a given amount of equity. In other words, debt multiplies the amount of activities of the company that can be supported by a dollar's worth of equity. This is why we refer to debt ratios as leverage ratios. They increase the power of equity. An alternate approach to measuring the importance of debt is to look at the ability of a company to make interest payments on debt. An example of this kind of ratio is the times interest earned ratio. It compares the ability of a company to make payments on its debt, EBIT, with the company's interest expense. A higher number is better since it means that the company has more earnings it can use to make its interest payments. EBIT, earnings before interest and taxes, is used because we want to exclude the interest payments from earnings, since we're trying to see if the earnings can make those interest payments, and exclude taxes, since interest is an expense before taxes. There are alternate ratios that use cash flow measures in the numerator. Generally, leverage ratios assume that having more debt is a bad thing for a company. As we'll see in the section of the course on capital structure, there are also some advantages to having debt. So when evaluating a company's use of debt in practice, you'll have to go beyond simply looking at the leverage ratios. One of the central questions for financial analysis is whether a firm is profitable. There are a variety of ways of measuring profitability, but we will focus on two commonly used approaches. The first emphasizes the margin that we earn on each unit we sell. This is called profit margin, and in its most general form is calculated as earnings divided by revenue. There are variations on this, but they all take the same form of some measure of earnings scaled by some measure of the amount of business the company does. From an investor's standpoint, this is not completely satisfactory, since the bottom line for an investor is not how much a company earns on each sale, but how much it earns for each dollar invested in the company. Return on equity measures the earnings per dollar of equity investment, and so is a better measure of bottom line performance. Return on equity uses historical data for both earnings and equity. This tells us the return that investors received historically. But if we're considering making an investment now, we want to know about its profitability going forward. The stock market provides some information about this, since we expect the company's stock price to reflect expectations about future profitability. The market analog to return on equity is the earnings yield. If we take return on equity and divide both the numerator and denominator by the number of shares, we get earnings per share divided by book equity per share. The market value of a share is just the price per share. Replacing book equity per share with price per share gives us the earnings yield. Earnings per share divided by price per share. So if a company has earnings of $3 per share and a share costs $30, then the earnings yield on a dollar invested in the company is 10%. Sometimes investors will talk about the cost of investing in a company in terms of its PE ratio. This is just the inverse of the earnings yield, and so is directly tied into expectations about the future profitability of the company. The DuPont equation breaks down the return on equity ratio to provide a better understanding of where a company's profits are coming from. In the basic version of the DuPont equation, ROE equals the product of the profit margin, asset turnover, and the equity multiplier. You can see how, if we multiply those terms together, revenue and assets cancel out, leaving us with earnings over equity, or ROE. Each of these items, profit margin, asset turnover, and the equity multiplier, tell us about a different way the company can be profitable. One way a company can be profitable is by having a higher than average profit margin. This reflects a strong market position where the company can charge a price greater than cost without having their customers stolen away by competitors. If we are analyzing a company with a high ROE due to the profit margin, we want to examine its market position to see if there might be threats from competitors in the future, which would force the company to lower its prices and reduce its profit margin. Even if companies have thin profit margins, they can still be profitable in other ways. Asset turnover represents how efficiently a company uses its assets. If a company can generate the same amount of revenue with fewer assets, it can reduce its financing costs, and that's good. An example of this might be a grocery store which doesn't earn much on each unit sold, but it makes it up in volume. If we were analyzing a company in this kind of industry that was underperforming in terms of profitability, we would want to compare its asset turnover ratio with its competitors to see if we could find efficiencies. A third way to profitability would be to use more debt and less equity, which increases the equity multiplier. However, unlike with equity, debt has to be repaid even if the company is in the middle of tough times, which makes this a very risky strategy. If a company's profitability is primarily driven by its equity multiplier, we need to pay careful attention to its ability to pay its debts in the future.